economists, solving the problem with carbon emissions is easy. We've known that since Pigou. You just tax emissions, tax price the externality, and you're done, okay? Now, it has been, I don't know if it's surprising, but it's been pretty hard to get this going. And I think one of the problems in particular with greenhouse gas emissions, obviously, is that it doesn't matter where you emit them, it has the same effect on the climate. So if you really want to, help, or combat the effects of climate change in your country, it's not enough that your country has a carbon pricing or carbon tax, but the world needs to have it, okay? Now, we're, I guess, pretty far from that, but, what we do have in by now quite a lot of countries is regional or local carbon pricing schemes trying to price carbon emissions. I'm going to talk mostly about Sweden in these introductory remarks. And Sweden, as you see, was one of the first countries in the world to actually implement the carbon tax in 1991, after Finland and Poland beat us to it. As you see, there was a bit of activity in this field, or in the carbon taxation in the early to mid-90s in Europe. Then not so much happened. I guess the next big game changer in Europe for sure was the EU ETS, right? Which is a EU plus Norway scheme with emission rights. And as you see, we're starting to see some other countries entering with sort of local carbon schemes. The US has there's the RGGI, which is an emission trading system for the eastern US. There's the California cap and trade, and so forth. Now, so this sort of is from the World Bank, by the way. We now cover 23.17% of global greenhouse gas emissions. Well, sure, I don't know if you think it's half full or half empty, but obviously it also matters how do you price it. What's the price of emitting carbon? Does it cover everything? Are there loopholes, et cetera? So, it's pretty clear. I guess it's, we have these carbon schemes. You might hope that it's better than having nothing at all, but I guess you also know it's pretty far from what we need, right? The theoretical first best, the worldwide pricing of carbon. Now, so the question is, these are regional. The tax rates or the price of emitting carbon, I guess, usually way lower than what the people like Nordhaus or the ICC and so forth, IPCC, tell us they should be, and they don't cover everything, et cetera. So this is a question, do they have any effect, or do they do any benefit, or mostly harm? And this is work, by the way, this joint with Gustav and Christian, who are somewhere here, I think, at least Gustav, I saw, and Laszlo. But when we started this project, there wasn't actually much research done on carbon pricing schemes and the effect of those at all. But anyone who knows me, I'm very slow at producing papers. So in the meantime, there are some papers. But the interesting thing is that the results go all over the place. Okay? So the people have looked then at various carbon schemes. There's some papers on the EU ETS, on the British Columbia scheme, on California cap and trade, and so forth. They use different methodologies. Some use sort of big aggregate country level or sector level data. Others use micro data. And some say, oh, this is awesome. We've reduced CO2 a lot. And others say, okay, I don't see any effect at all. So it's a little bit all over the place, which maybe is not so surprising because these schemes look very different. They price carbon very differently. On top of that, the response of firms is likely to be very different too. Okay? Some companies might have a very easy time reducing greenhouse gas emissions in response to the tax. Other firms, it might be impossible or super hard. So anyway, one of the nice things with looking at Sweden is that we've had the tax for so long that we can start doing some serious empirical evaluation of this. Now, that said, CO2 taxation is part of, I guess, environmental taxation in general, and it's a jungle. Okay, it's a very hard. It takes a while just to understand the various different taxes that could have some bearing on environmental or pollution and emissions just in general. So in Sweden, there were lots of environmental taxes and actually energy taxes around for a long time before that. Energy is a nice thing to tax because it tends to be quite inelastic. Okay, so it's a good source of revenue for the government. But the carbon tax that was introduced in 91 was basically, the little circle there was part of or added to the energy taxes. And it sort of distinguishes between two types of emissions that they call mobile and stationary. Stationary is, or mobile, that's basically transports, okay, cars. So fuel, gasoline was subject to tax. Stationary is businesses that emit CO2, either from heating, which is the big, obviously big thing when you heat with fossil fuel, or through the production process. For example, if you make steel. Full disclosure, I went to social science track in high school, so physics is not my strength. But steel is basically you add coal to iron. Okay, right? And in that process, it emits CO2. Okay, so there's also certain types of manufacturing, steel, cement, and so forth, that just making it, you will emit CO2. Now, we're interested, okay, did our tax have any effect? Did the tax matter for emissions? Now, this is not even answering that question. It's just showing you that indeed, over this period of time, carbon emissions in Sweden have gone down quite a bit. Now, the studies that I'm gonna give you some examples of is a study on this blue thing. Okay, that's the emissions from transport. Okay, and that's not my work. That's another researcher at the SSE, Julius Andersson, whose paper I'm going to mention. And then there's the manufacturing emissions, which is what the project that I'm working on with Gustav, Christian, and Lasso. Now, just transport emissions. This is a very nice paper that received the best paper prize in the AEJ Economic Policy. Looking at did the Swedish carbon tax have any effect on transport emissions? Now, in this kind of research, as you know, the problem is finding a counterfactual, right? There are trends. If we look at this picture, sure, the Swedish carbon tax might have worked because, carbons went down. Well, what happened in other countries, maybe countries that didn't have any carbon tax also saw a reduction in emissions, right? So you have to find the right counterfactual. What Julius does in his paper is he uses a method that's called synthetic control. So he constructs a synthetic Sweden, okay, which is the counterfactual based on other OECD countries, properly weighted, and basically finds that, yeah, it looks like the Swedish carbon tax did reduce CO2 emissions from transport, and close to 11% or so. Now, what we're doing is this part that was called stationary emissions, which and actually the stationary effect, the two big sectors that were affected by that. If I go back here, one obvious one that we don't look at here was electricity and heat. Okay, so utilities were taxed to the extent they use fossil fuel. Sweden is a little peculiar in this sense, though, because we're in a good spot that we have lots of hydro, and we used at least to have lots of nuclear and so forth. So we are sort of in relatively good shape already coming into this in terms of carbon emissions from utilities. Okay, so we're going to look at manufacturing emissions, and without going into, I'm going to tell you a little bit about the tax scheme, but just one of the things that you need to, or important things to keep in your head when you think about carbon taxation is that there's, a relatively small fraction of sectors, or even a relatively small fraction of firms, account for the bulk of CO2 emissions. Okay. So if you really want to have an impact, you don't want to look at the average impact on the average firm. You know, the big deal is like, okay, how does it affect the big emitters? So this is just a graph from our paper. To the left, we basically divided manufacturing sectors into 10 bins, depending on how much CO2 do they emit per unit produced. D10 is the most emitting, sort of 10% of firms. To the left there, you see how much of manufacturing output they have accounted for. To the right, you see how much of CO2 emissions they've accounted for. So you basically see that the sort of 10% most emitting subsectors of manufacturing, you know, they emit 80, 75% of all the CO2 emissions from manufacturing. That's where the action are. Who are the culprits? Well, we find refineries, paper and pulp, basic metals. Most of that will be steel in Sweden. Non-metallic mineral products, what's that? Well, it's sort of concrete or cement, glass, ceramic, tiles, chemicals, and food. One of the, interestingly, super CO2 emitting sectors, sugar, apparently, sugar production. Those of you who took science track might know that, why that is. Okay, so when what we want to understand in this project is, okay, how do these firms respond to carbon pricing? Interesting thing, this is actually something that might make you upset as a taxpayer, but happy as an econometrician, is the fact that the Swedish carbon tax was designed in what economists probably would say, not a great way, and it was also changed numerous times. Okay? Now, as an econometrician, that makes me happy because there are various exemptions and changes that are great for econometric identification, as we call it, to actually estimate its effect. So just to give you an example, so when we started, this is in 91, the first carbon tax was in place, and okay, it was at this level, you start emitting, you pay a certain number of kroner per ton. But then we also realized, we don't want to kill off our manufacturing industry. So we're going to cap the amount of tax that you have to pay. Okay. So after a while, then basically this is the marginal tax. Okay. Once you've paid this much, you didn't have to pay anymore. Now, from an economics point of view, this is kind of stupid because you're putting a pretty high tax burden on these firms to start with. Okay. But they have very little, if you're out here, you have very little marginal incentive to change anything. Okay. And then, so that's sort of, this illustrates this for two types of firms. The yellow one here, these are marginal tax rate, these red and yellow lines. I'm colorblind, but I think this is red. For the yellow one is for a high emitting firm that is sort of above a lot of these exemption thresholds. The red one is for firms that are below those exemption thresholds. Okay? And what you basically see is that the marginal tax, you know, for big parts is lower than for the high emitters and for the low emitters. This little thing here is actually the average tax paid for these by these high emitters. So they actually paid quite a bit of tax, but they had relatively low marginal incentive to do it. Now, this changed with the EU ETS. So in 2007, I guess, we entered the EU ETS. What that meant was that manufacturing plants that had some facilities that were big enough and emitted CO2, they could be placed under the EU ETS, where you get emission rights or have to have emission rights to cover your emissions. Those, for this part that we look at, you got those for free. Okay? And Swedish firms actually got usually more of these emission rights than they sort of needed. So the tax paid was now way lower than the marginal tax, which is basically, or the marginal benefit of reducing CO2 emissions, which is the price that these emission trades trade at. Okay, so what do we find? Well, I guess, first of all, so we basically try to estimate these, you know, what we call, economists call elasticities, right? So if you increase the cost of emitting carbon by 1%, how much does your carbon intensity, and that's what we look at here, so the carbon emitted per unit produced, how much does that increase? Okay. And the baseline estimate we get is 2. So if you increase the price of emitting carbon by 1%, your carbon intensity decreases by 2%. Okay. Now, we also, I'm come to the aggregate significances, but let me just stress the number 2 here. The heterogeneity is huge, and unfortunately, it turns out that the big emitters have the lowest elasticity. Okay. They're still significant, but it's the big firms, steel and cement and so forth, have a pretty hard time reducing, or it's costly for them to reduce emissions in response to a price, and their sensitivity is lower. The sectors that don't emit much, they actually reduce quite a bit, okay, and have quite high elasticities, maybe around 3, okay, compared to, let's say, 1.5 for the high. Then, this is not the finance paper really, but we sent it to a finance journal and they wanted us to put some finance in it. Interestingly enough, we do find that financial constraints matter also for these elasticities, for their ability to respond. So firms that are sort of constrained in getting funding and they can't make the necessary investment to reduce, well, they have lower elasticities, okay? I think this points to one of the flaws in the Swedish tax system, where you have these big emitters, you give them pretty low marginal incentives, and they pay quite a bit of tax, which makes them even more constrained and harder to actually reduce emissions. I think...
No more slides.
Yeah, just want to say the bottom line, when you weigh this together, yes, how important is it, okay? So according to our estimates, if in 2015 we wouldn't have had carbon pricing, Swedish manufacturing would have emitted 30% more CO2.
Great. Perfect. Thank you, Per. So Adair, I'm just bringing this tax in the US up to tissue. That's actually up to you if you want to talk about that. But in some way, share a little bit with us the US policy perspective on climate and carbon.
Yes, so thanks. Let me just point out the size of California and Sweden.
Yeah.
Right?
Yeah. California is the world's fourth biggest economy.
Yeah, 7, I think. But in any case, just quickly on tax. So the U.S. political environment is not such that there is a carbon tax at federal level, at the national level, right? Without comment, or minimal comment, the politics around climate became polarized in a party way, the similar way that vaccines did in the United States. It's unfortunate. However, we have moved forward in other ways that are also proactive, and arguably, given that most of the countries outside of Europe also have not gone this way for reasons of affordability, arguably this other environment of carrots at least helps in moving the needle. So I'm going to no more on that, right? Obviously, the role of carbon taxes in Europe has been incredibly productive, and we wish we could all just jump to that equilibrium, but that's not where we are. So having said that, let me talk about carrots. So in the United States, back up. So I sat on, in the Treasury Department, so I was Deputy Assistant Secretary for Capital Access, arriving with the beginning of the current administration. And I coordinated the climate activities inside Treasury on except for the tax incentives side, right? So on the non-tax side, so the investment side, part of the IRA, part of the CHIPS Act on semiconductors, and so looking at investments out and in conversations with the large financial institutions on the net zero commitments, the voluntary carbon markets, the state and local government fiscal responsibility over infrastructure, a whole host of climate items, as well as I sat on the small group industrial strategy of the US group at the White House. So this was my awesome job I've had for the last 2 years. And I'm 2 months out now, having hit my 2-year mark, and Berkeley said, it's time to take care of climate curriculum at Berkeley. So with that perspective, being part of the transition and having lots of conversations with industry players on the finance side about the transition. I want to say a few things about opportunities. I was also on conversations with the SEC and other regulators about financial risk, but I'm going to talk about opportunities here. So the first thing, with the passage of the infrastructure law, the CHIPS Act for semiconductors, as well as the Inflation Reduction Act, climate money, the idea that the EV transition in the United States is going to happen became almost completely secured among financial institutions. If you ask the CEOs of the banks or asset managers, the EV transition is happening. On top of that, the electricity transition was already moving such that the margin was renewables, right? And so those two transitions are happening. There's a question of speed, and that matters a lot. But with those things moving, the name of the game is really about opportunities and who's getting to those opportunities and who's in there financing the opportunities and grabbing them. And it's not a zero-sum game, I should point out. So Al Gore tours around and he says wonderful things. One of the things he says is that the Europe and the US don't really matter because the emissions problem is elsewhere. But the reality on that is the supply chain and these other industries, the supply chain in the EV, in the electricity grid, is not ready. So there are all kinds of frictions on little things. There may be money for big things, but if we don't have transformers for the electricity grid, if we don't have labor for what we need in critical minerals, if we don't have mechanisms to do the ag innovation proving out to scale, or implementing the innovation side of scaling up in things that have been proven, then we're not getting things such that they're affordable for other countries to do as well. So this is what the US's role is, and we all work together because everyone needs to do their role. And Europe has provided leadership on the things that Per is talking about, as well as many other things on information and getting thinking in the corporate offices around climate. But the US's role now is to go down this path of solving the industries, and it's not just solving the innovation side, and it's not just solving the obvious needing EVs. It's all these mundane things in between. And the nice thing about the mundane things in between is these are not captured in the US by just the coast, right? If you think about the tech revolution, the computing revolution that we've had over the last 30 years or so, it's been very coastal. And you can feel that in the United States. Here, what we're talking about is supply chain stuff that is middle country, right? Throughout everywhere, right? There's a need for all kinds of SME manufacturing, new logistics, new understanding of labor in different ways. And so, I'm reminded of the different revolutions we've had, the Industrial Revolution, the robber barons, trains, right? And now the revolution that we've had, that I just mentioned in computing, has been a unequalizing in income and wealth, right? But if you go back and sorry to mention the plague in history, right? One of the things for Europe that happened with the plague is it was an equalizing revolution in farming, right? It's sad to say it that way, and my apologies for saying it that way, but it brought up, because there was too few laborers, right? The feudal system got eroded in many places in Europe, right? We're in that setting where there's too little on supply chains and too little in labor and logistics, and so that becomes potentially equalizing. So one of the things that we think about, is this democratization of the opportunity as we move into the climate transition and ensuring that getting things to scale so that the innovations can be adopted globally for economic reasons. None of us have enough money in our governments to fund the transition. So the mobilizing of private capital, which comes us to the finance overlay here. So we talked this morning about some innovation, a number of papers on the innovation, and we talked about banks. I want to talk and we talked about private equity, but I want to talk for a second about banks in terms of the net zero commitments. So the large banks have made net zero commitments, both in Europe and in the US. These, the thought about net zero commitments when they're put out is, well, okay, we're going to see the reduction for that particular firm in this bank's portfolio, say a big fossil fuel company, going down year over year. And that's the way it's set up to measure. If you talk to the banks and you ask them, how is your portfolio going to be consistent with net zero? Yeah, maybe there's this, the going down year over year, and that's where the pressure is, particularly in Europe speak. But where they see their opportunity to get their portfolio to be net zero is in the big checks in structured debt, the big checks in leveraging deals on the green side. So looking for opportunities. So Pear's cement company. What the big bank that has the cement company as a client would like to see is that the cement company creates a new division and the bank of the cement company invests in that new division. Then that brings over time, if that would count, that brings over time their portfolio net zero rather than the year over year, which is never sufficient to get there given the dynamics of playing the net zero game and needing the transition adjustment. So in terms of the financiers, what I just said, are we doing any research in net zero? Not really. Are we creating the transition asset class? So a lot of the time I spent at Treasury is trying to mobilize private capital in a way that can go alongside the public capital, public-private partnerships, structured deals with corporate VC, right? Why is it the cement company not the corporate VC in this sector? It's because no one's structured it. So the role of financiers and the role of researchers in this area to structure the transition asset class so it becomes fiduciary compatible for fiduciaries that say, that need the risk of return. We all need to pile into this area, and everyone, the industry loves it, right? Because this is making the opportunities work. And so it is a win-win that we devote and double down on doing things along those lines. The final thing I wanted to touch on, having lost my train of thought, but the final thing I wanted to touch on is the different, the focus on the finance research on the different incentives for investing in the transition and the negativity around climate. If the incentives for investing in the transition, all of the research that we do, not all, the vast majority of research we do is about financial returns, right? In terms of climate, ESG research is financial returns, the expected financial returns, right? Both of those things. The reality of understanding that expected part and what is the risk profile of a portfolio without having the green side, right? With having a brown side, but not having the green side, we haven't done enough there. And so understanding that risk piece is crazy important for the people that do large, financial markets, and so that we can mobilize solutions in terms of what the SEC is able to do in the United States, as well as just having it make sense for all kinds of fiduciaries to be able to place money there. So the final thing would be, yes, we need to understand personal wealth's incentive to invest in this, but even more critically, we need to have really good, solid research come out and characterize that risk profile. I know you're going to say we don't have enough time series data. I know, but we need to be creative and find ways to mobilize this research to support what we can do on the regulatory front and how it supports the fiduciary money coming in. So over to you.
Thank you, Adair. Yes. Before we turn over to Patrick, let me ask you just a quick follow-up question. So it seems like you talked about industrial heartland or the non-coastal areas, and those same political pressures around fuel and energy prices exist, in developing countries and in Europe as well. Here in Sweden, for sure. In France, you have the yellow vest. Do you feel like that you managed to find a way here to sidestep that a little bit by having this sort of pro-industrial framing and content of climate policy? Make it more attractive for the rural people?
Surely what you said is how we ended up with it getting through Congress, right? So surely that is the case. Ex post to that, everyone could be on board. The IRA, if you look at the incidence of where the IRA money will go, it is more to Republican states than Democrat states in the US, right? Just because of the industrial organization of the United States. And so that is pretty important for the mobilization moving forward. So hopefully this whole idea then will de-escalate the polarization of climate in the United States as the jobs move out in a way that the population supports. So hopefully, but for sure, that is the industrial policy view is how Congress was able to act on climate. And it's a pretty important piece for then if you think about other countries facing similar things where they have large climate fossil portfolios, that how can you mobilize momentum there? And taking that lesson of where can you gain from the supply chain, whether it's the supply chain internally or to us, to North America and Europe, mobilizing that benefits is kind of a thing that's been missed in the COP conversations and others about how we can get a positive spin going that enables people to pile in.
Good, excellent. So Patrick, you've thought about these issues longer than almost anyone. So I will give you no suggestions on what to comment on. Please give us your thoughts.
Thanks, Bo. Thanks, Per and Adair, for a lot of really interesting points that have been raised and results. And we've covered a lot of ground already in 20 minutes? So let me react to some of the things that you've said and then build up from there. And so where I want to start is where Per started, which is he said, when you emit carbon in Sweden, it's an externality that is paid by the whole world, not just Sweden. It's a global problem. It's a global problem. And we forget this too often. So it's a global problem that needs a global solution. And it's not sufficient to think of country-level solutions. Now, of course, we think of country-level solutions because we live in particular countries, and we're part of the political process, and we want each country, our countries to do more. But it's a global problem. And what's the main first implication of that? Main first implication is that you can't, at a global level, you can't think in terms of, it's a global carbon tax. You can't think of that because there is no global government that would set a global carbon tax. That if we had a global carbon tax, it could only come through an international agreement. So really, what we need to think about is how do we get an international agreement, right? So I think that's really a very important point. And what I take from that is, if we start talking about international agreements, if we start talking about what Adair spoke about the US, we can't have a carbon tax in the US, we have to have some other policies. What do we find? We find that we are actually already very far away from economics. And we're in the world of whatever you want to call it, international relations, politics, with everything that comes with it. And, we have to accept that. We can't just ignore it. We have to bring it on board. So where does that cut? If you can have an intervention, because it's an agreement, you don't have to think of an intervention just through pricing. You can also intervene through quantities. And in Per's analysis, there was a mix, pricing and quantities. The quantities part was the European emission trading system. It's a quantity intervention. And there, what I wanted to add to your analysis is some work I've done on EU ETS. And so what you find is that, so EU ETS went through multiple phases. We're now in phase 4. And we had phase 3 roughly from 2013 to 2022. Yeah? Much of the period you cover is phase 1 and phase 2, and as you pointed out, free allocation of allowances, it was a mess. It was like, how do you decide what you should, how much you should allocate? There was some fraud involved, all kinds of things. The price at which these allowances were trading was ridiculously low. It didn't exceed 10 euros per ton of CO2 until 2018, roughly. And it's only in the later part of phase 3 that the price started to rise. And so phase 3 was really when the European ETS matured. And it matured because no longer mostly free allocation. Now you had to actually bid for your allowances, and you had to bid an increasing fraction. And you had an aggregate reduction in emissions that was mandated that became more and more binding. And so much so that today, in 2023, we've had, I don't know the exact price today, but in 2023, we've seen that the price of a ton of CO2, an allowance for 1 ton of CO2, exceed 100 euros. Okay? And so what that does, and here's where I'm going in the direction of your findings, what that does is it becomes material. And so what do we find in our analysis? We find that once the price starts rising, above 20 or 30 euros per ton of CO2, you will see the effects of price changes in allowances in stock prices of the companies that are under the system. And the effect is as follows, that's also very interesting, is if you have an allowance shortfall and the price of the allowance goes up, then your stock price goes down. If you have an allowance surplus and the price of allowances goes up, your stock price goes up. So you really see here, the connection between the pricing of carbon and the effects for investors showing up. You see that as the price of allowances rises, companies try and cut emissions because it becomes expensive. But they only cut, and here's bringing it back, circling back on the global thing, they only cut emissions that are under the scheme, the so-called verified emissions. But when you actually look at their total emissions, companies' total emissions, no reduction. So what is happening is they reduce the emissions that are being priced and they move activities elsewhere where the emissions are not priced. And so this point is that we can't just think of a national solution or European solution. We have to think of global solutions. Now, on the points that Adair made, you really have to understand that IRA, so Inflation Reduction Act, big misnomer. That's another one of these euphemisms, right? You're not allowed to call it climate whatever. You have to say, Inflation Reduction Act. It's a sea change. It's a sea change. It's a really important intervention. Really important intervention. I was at a conference they organized by Lazard in New York in April, and everybody was just talking about this. That being said, as you pointed out, there are bottlenecks everywhere. So there's the grid and plenty of other things. So, for example, there was a company saying, there was a CEO of a company retrofitting or building trucks, electric vehicles, right? And he was explaining that in Southern California, he couldn't get a contract with the electric utility provider for more than 15 charging stations for trucks. Why? Because the capacity was already full. And then we had another CEO who develops, energy infrastructure and energy facilities. He said he'd been involved in a development project on a transmission line, across multiple states. He said it took 18 years from beginning to completion. Yeah. So the bottlenecks are huge. And so we really need to understand that. And I think so maybe that will be my final point. What this brings out is that we can't think of this problem as just a pricing problem. It's much bigger than a pricing problem because we need to fix, I forget the word you're using, the small, I forget what you said, but it's a massive scale industrial policy problem. And we can't just ignore that. And the challenge now for the US is how do you get a grid that will be able to absorb the increased demand for electricity that comes from the switch to electric vehicle? How do you get that? And then how do you solve all these bottlenecks along the way?
Okay, very good. We do not have time for my follow-up questions, but even so, I think maybe we should just see if you have any reactions or comments on each other.
The carbon leakage that you brought up, one of the things that that mitigates that in the Swedish case is that it turns out that the big emitters themselves, the steel companies, paper and pulp, cement, are not very movable businesses. Okay, so while there might be some evidence of carbon leakage, it seems not to have happened much in actually the sort of the big emitting sectors. Now, there could be indirect carbon leakage in the sense that the Swedish steel companies are competed away by Chinese steel companies or Indian steel companies that produce cheaper. We can't get that in the thing. But one of the things that I sort of heard also is that there, which is sort of interesting. There's a lot of I think you mentioned there's a lot of private money interest in transition, right? I mean, financiers aren't doing this because they all of a sudden woke up with a good, feeling. I don't want to make money anymore. I want to be, help the world. They want to make money, and this is where you can make money, okay, in the transition. But seems like one, and I work a lot on private equity and private capital kind of stuff. In the green infrastructure space, there's been an enormous amount of money raised over the last years. They have a hard time deploying it, and one of the reasons is apparently the legislative or regulatory process. So you mentioned something about the
permitting,
right? That it just to get permits, all the sort of local politics involved. Not in my backyard type of reasoning when it comes to building windmills or whatever. Is that something that you sort of had dealt with or tried to get some?
Yeah, it's an enormous. These are enormous frictions on the examples you gave, but there's a gazillion other examples along the same lines. And so helping to organize the small stuff so that big money can come in is where there's a big hole. If you look at the conversation around venture capital, there's a conversation that there's these enormous venture capital funds, and they're not deploying as much of that capital. There's a little bit of, there's a slowdown for climate venture capital. But the reality is that's early stuff. This late stage scaling up existing manufacturing, growth equity, all of this is where the game is that overlays into infrastructure. And we've got to figure out how to solve those bottlenecks. And that's, yes, it's interacting with policy, because policy is a hindrance, but it's also interacting with policy in mobilizing the IRA and the infrastructure funding that's de-risking here or doing things that you know, crowd in private capital, because these sometimes the government may not be the most fluid in mobilizing financial structures. And so the idea that it's either infrastructure government pays, or you know, maybe government pays for R&D, we're missing the boat. It's all the stuff in between, and private capital and government need to work a whole lot better in between, right? And so that would be, it's not a great solution, but it also enables getting the regulatory people on board when you're working with, you know, bringing a lot of money to the table for the government helps with getting mobilizing conversations around the permits as well. So not a great answer, but yeah.
Good. Okay, so one thing I would like to bring up is everybody else. So we talked about Europe and North America. Suppose the audience is Indonesian, Nigerian, or Brazilian policymakers with all their constraints. Do you have any thoughts about how we can help them maybe impose some carbon tariffs on their products or subsidize R&D? I'm kidding. But do you have any thoughts? Because it's a global...
I mean, the big topic in Europe has been the border adjustment, carbon border adjustment tax. That has a lot of economic good, solid reasoning, because it's a clear way in which you can fight leakage. But there are other initiatives that are just as good, and I mean they're just starting now, and it's less well known. So one initiative, for example, is there's been, I think there are 3 examples. There's been one in South Africa, one in Vietnam, and one in Indonesia, where basically you have developed countries, you know, Sweden or European countries, they go to South Africa and they say, we'll pay you to close your coal mine. And the point is that it's much cheaper to pay a South African coal mine to close than West Virginian coal mine, as we know, right? And so there are plenty of opportunities like that if you start thinking global, and you know, maybe thinking a bit further into the future. We really want to encourage everybody to all the countries in the world to be much more proactive in how they think, how they're going to plan the energy transition. So there's far too little of that. And you know, the kind of frustration that you have because of that, because of the lack of planning, is, for example, today in Pakistan and in Bangladesh, 2 countries that are most severely affected by climate change. I mean, think about what happened in Pakistan last summer, and you know, and in Bangladesh. Well, because they didn't plan anything in terms of their energy supply, what is Pakistan and Bangladesh doing? They're building coal-fired power plants. That's the absurd thing.
Quickly building on that, there's the concepts around these hard to abate sectors and having the abatement be paid for need to be combined with what's going to happen to that community. For one, because we should, and for two, because it makes economic sense. So understanding that we're in this massive transition for need for supply chain redundancies, we learned that strongly in the pandemic. For not just for climate, but national security issues and other kind of issues, right? All of that came to the fore that supply chains are not what we thought they were. And just in time has perhaps some limitations when you think about these disruptions. And so the idea of new supply chains being part of, for the transition, being part of the vision in closing communities around coal. You know, what can we do with that community built there, those workers that have skills, and the infrastructure that we have there, can all of that be repurposed in a way that generates future revenues for that community, that is community driven, not us flying in and saying things, whether that be in Europe, US, or wherever, in Bangladesh. But then it also is the cheapest way to do things. To be economic about it, right, is because you're once you're closing something, having revenues come up, it mitigates the problem that of solving for livelihoods, which we must do. And so we need to put that together, but the teams that think about these things don't speak that language, or they're different teams, right? There's the close, there's the donation funding thing, which is not finance, right? It's just straight funding. And then there's people that think about developing new sectors, and that all of this is disjoint, and it needs to be one set of people going in with solutions, given that we have transition needs and need new supply chain channels.
Yeah, absolutely. I mean, the thing that's, you know, speak about coal mines and coal communities, right? I mean, being a coal miner, that's got to be one of the worst jobs you can have. It's like, you know, going down into, you know, it's not good for your health. It's extremely risky. It's very unpleasant. And yet, the coal miners are extremely attached to their coal mine. And I think to your point, why are they so attached? I think this is really something we really need to take very seriously. Why are they so attached? Because they're attached to their community. It's not just a mine, it's a community. And what you don't want is to close the mine and not do anything, and then the community dies, right? That's what you don't want to do. And it's happened a lot. I mean, when coal mines were shut in the UK under Margaret Thatcher, communities died, whole communities died. So you do need, indeed, you need to do retraining, you need to create new jobs so that the communities can continue. But it's not, as you said, actually not that expensive. You add up all the costs of all those interventions relative to the benefits of the reduced carbon emissions from shutting down the coal mines, because those benefits are enormous. So basically, the main risk with respect to a warming climate, in terms of expected costs, physical damage costs to GDP, the main risk can be significantly reduced just by shutting down coal mines. It's a massively beneficial intervention.
Also turns out, when you go back to carbon pricing, it's actually the one source of fossil emissions that you can price out pretty quickly with a relatively low carbon price, because the margins aren't that high compared to oil.
Can I just say something on agriculture? Just because where coal mines are hard to shut down, it's expensive to shut down, a huge benefit. Agriculture, if there is I'm going to use the word technology, but you can think livestock or seed or soil practice or whatever, climate tech. If there is something that makes more sense for farmers, you have a natural adaptation once it's proven, right? Farmers, millions and millions of them all over the world, will implement things that lead to more profits. Now, granted, there's different climates, there's different everything worldwide, there's lots of different things, but there's the mobilization of change. In agriculture, we are not focusing enough. We talk a lot about food and not as much about just the growing and the need to get to scale on some of the new innovations that can be adapted in India, in Brazil, in wherever, as well as the United States and France.
Well, we've been praising EU for being very forward on some of these things. GMO is not one of those areas.
Great, okay. I thought we were going to talk about fusion, but we never got there. So then we'll wait for the next panel. And I think we have a 10-minute, just quick in and out, and then we start with the last panel of the day. Thank you.